All right, let's go ahead and get started today. So the session is being recorded. So today is Monday, October 5th. We are going to go over mostly homework 4 and 5, get us ready to do the group project and upcoming midterm, and get ready also to get into more of the understanding of the historical analysis of a company. But before we go there, I wanted to do a quick check-in on the Bloomberg Trading Challenge assignment. So I'm going to go ahead and share my screen. So if we look at the Bloomberg Trading Challenge today, either your team captain can go to idea or team message, TMSG. You'll select your section. This is section 301. And here is kind of a representation of today. So the column that matters is portfolio value. And you're going to be scored from highest to lowest. This is the current ranking for your section. One thing that also is going to matter is the number of longs. And for the first half of the semester, which ends in a couple weeks, you need to have at least 10 longs. So 5 of the 6 teams have met that criteria. I don't really count. I did 1 trade in the first day of class. Right? So this team needs at least 2 more longs to qualify. But basically, this is how you're going to be scored. No one can have more than $300,000 worth of cash. So in this case, you guys are all good on that. And as I said, right now, it's relatively close. $1,039,000 versus $1,037,000. So this could actually flip by the end of the day. But essentially, of the 2 companies in first and second place, everyone in the section has made money over the last few weeks. And so if the trading were to end today, this team would get 5 points, then 4, 4, 3, 2, 1 towards your semester grade. Okay. Hopefully pretty straightforward. Questions about the trading challenge? I know you don't always get to see the names of the other teams. Just kind of give you a view as to where we stand as of today. By the way, if you were to sell, because I did get a question about how do you sell a stock, just to make sure we all understand that. If you go into here, circle red X is how you sell. Okay, so if I wanted to sell this company, close the idea, and then that would actually sell all the shares. But one thing that's important is you don't see the circle red X if you don't click your drop down industry first. So if you don't click this first and go into your account, you won't see the circle red X as an option. You have to click on the drop down first, then go into your industry, and then you'll see the closing idea as the option. All right, so in addition to the trading challenge, as I said, the other thing we were working on today is homeworks 4 and 5. So let's talk about homework 4, where we had to create a custom operating ROIC for not only CVS, but for use in the rest of the semester. Okay, so again, to do that, there were 2 areas that you can create a custom field in Bloomberg. You can either do that in EQS or you can do it in RV. Okay, so you cannot do it in FA. Okay, so in FA, you can export data in Excel and manipulate it outside of Bloomberg. But if you want to actually add a custom field or custom formula, EQS or RV. Okay, now again, would probably be easiest to do in the custom section. Click on the little gear icon, add formula, and here is where you would have typed in your custom formula. Your custom formulas, as you build them, will show up here on the left. And again, once you build a formula, you can also use a formula within a custom formula to build more custom formulas. So following the instructions for homework 4, first part, you should have created a custom field called Operating ROIC. And that would have, for last year, because that was the time period we used when we custom built the field, given you an operating ROIC for this list. Now, I'm just using this comps list arbitrarily. Those of you that in the EIC assignment had used this comps list, you lost points, because obviously for doing CVS, they have more companies than this as we think about them. for their peers. So for example, Walgreens, Rite Aid aren't on this list. But nonetheless, this is at least a default list that we can all use. Best fit algorithm, whole firm, country domicile, US. But the point is, this would be the industry average. And then this is the operating ROIC for CVS. 7.88% if you did it correctly. And then you also could have done, as a comparative purpose, the Bloomberg ROIC, and you would do the latest year, because since this was last year's operating ROIC, apples and apples, latest year ROIC as opposed to latest filing. And then you would have also done the spread by typing in the WACC. And the WACC is the current WACC. If you want a previous WACC, you have to go to FA. But essentially, last year's ROIC, current WACC, that would be the spread. So going forward, when we do EIC and other assignments, and I ask you to do the I and the C, it's based on the operating ROIC performance of the firm. It's no longer based on the Bloomberg ROIC, okay? Because that is a clearer view of the operating performance. Now, if you don't have an operating ROIC, and you're only stuck with the Bloomberg ROIC, you to calculate one or use the Bloomberg one as a proxy. But remember, the Bloomberg one basically has non-operating assets and operating assets mixed in. This is a cleaner view of the operating performance of the firm. For a company like CVS, not much of a difference. For a company like Humana, dramatic difference. Anthem, dramatic difference. Okay, so that's going to really affect analysis and valuation as we go forward. But hopefully pretty straightforward. You didn't need this column in your assignment for turning in. And what you're really going to be judged on is, did you get 7.88? Questions about this part of homework 4? All right. So assuming there's no questions about this, let's talk about the other part of homework 4. Next, you would have had to use the equity screening tool. So basically EQS. And as I mentioned in the video, this is the section of Bloomberg, which has 1.3 million securities in it. And you can screen against just about any criteria in the database to screen and filter out the company list, right? So the screen that I asked you to look at is companies that were in the S&P 500 index. So S&P 500 index. And then when you hit enter, it basically filters down to 505 companies. Again, there's 505 securities in the S&P 500 index, which represent 500 companies. For example, Google/Alphabet is in there twice because they have a Class A share, Class C shares, right? So again, multiple classes of shares, same company. So 500 companies, 505 classes of shares. All right, our next screening criteria would have been to use the operating ROIC calculation. And we wanted to have, and you can see here is a custom field now available to us. And we wanted to say greater than, in this case, 20 for 20%. And that would have basically taken 122 of the 505 companies in the index, securities in the index, would basically meet that criteria. Okay. So now we want to add revenue growth rate. So if I type in revenue growth rate year over year greater than 15%, right? And then two things matter. Number one, and this is my fault, I didn't tell you whether or not to use last quarter or latest year. Now, ideally, I wanted you to use latest year, okay? But I will let you know that ambiguously in the instructions, I forgot to mention to use latest year. So if you had used latest quarter, which is the default, we're not going to penalize you on this assignment because that was my mistake, and you will basically get credit. And I'll show you both solutions, right? But basically, I wanted you to use latest year, okay? And then the other thing that matters is this and or, right? In the screening criteria world, you're using these logical screens. So if you say or, then it would mean if it met either or criteria. So it would get a bigger list, right? So since I want to have both criteria overlapping, I'm using an and. So 122 companies, become 17. Okay. Next, we wanted a bull beta. And we wanted the bull beta again and to be greater than 2. So back to the bull beta. As we know, we've been talking about beta. What beta does, it just looks at the change of a company versus the change in the market every day. Okay. What the bull beta does is it ignores all the down days. So it just says on an up day, how much does this company do when the market goes up against the market? A bear beta excludes all the up days and just looks at the down days. Okay. So again, if I'm thinking about a bull market and I'm thinking about companies that are going to outperform in a bull market, bull beta. If I'm thinking bear market and I think companies are going to outperform in terms of do worse in a bear market, bear beta. If I don't know what the market is and I'm not worried about it, I'm just thinking about any change in any potential day, beta. Okay. So again, different ways of doing this. Now the default here is 1 month. I didn't tell you to change it. So again, companies that had bull beta greater than 2, and it's an and, that takes our company list from 17 to 6. And so down here, see results, display results, and then this would have been your solution. So you had these 6 companies. Now, if for latest SY revenue, you had said instead of latest year, you'd use latest quarter, which you've been saying quarter year over year, as opposed to annual revenue growth year over year, you would have had 5 companies. And when you clicked on see results, it would have been these 5 companies. So again, if you'd use year over year, 6 companies, quarter over quarter growth rate, 5 companies, because I was ambiguous about that period, we will accept both as part of the solutions. All right, questions about homework 4? Or anything we've covered here? So in addition to this assignment, the other thing I would say the equity screening tool is helpful for is your Bloomberg trading challenge. Because as you're looking for stocks that meet criteria, you can pretty much search just about anything in the Bloomberg database. So for example, let's say that you made an assumption that the Democrats might prevail in next month's election. And as a result of the Democrats prevailing, tensions with China cool down and the trade war starts to come to an end. Well, you can actually go in here and, for example, if you typed in revenue, you can look at not only product revenue, if they break it on their 10K, but geographic segment revenue in dollars or as a percent. And so, for example, we could look at companies that had a large exposure between the US and China. And so if I'm a US company, who has exposure to China? And I could use that to help me as I start thinking about which companies might be affected if the trade situation changed, just as one example. But there's a lot you can do with this tool. And again, just another powerful feature to use within Bloomberg. All right, so that was homework 4 with the screenshots, hopefully straightforward. So now what we want to do is talk about homework 5, which is the economic statement conversion. So for this, I'm going to share my desktop. And so as a reminder of what we were doing, where is our preview is here. Okay, I want to go back to the lecture notes. So process-wise, what we're doing is we're mapping and converting income statements and balance sheets to the Modigliani-Miller 4-box format. And so we're starting out with an income statement and balance sheet, and we're labeling them, putting them into operating, which will become the 1s, non-operating 2s, debt equivalent interest-bearing 3s, or equity cash flows 4s, and we're just remapping the income statement and the balance sheet. Okay? And this is the labeling process, which for this assignment and all the way through the midterm, I have done for you and will continue to do for you. Okay, so I am giving you the labels. Now, post midterm, you're gonna have to figure this out. We deal with real world companies, like what's operating, what's non-operating. But as you're getting started, for these assignments, I will help you with that. And again, the idea of an operating cash flow, the box one cash flow, is these are things that you invest in that are directly leading to the sales of a company. Okay, so they're recurring. It's a normal course of business. You sell more stuff, you tend to spend this amount of money. As opposed to a non-operating cash flow, which has nothing to do with sales. And so they may go up at a completely different rate. And I don't need to spend money on non-operating cash flows to sell more things. So two different types of investments. In a traditional statement, accounts don't break this out. In our statements, we're breaking this out. And that's where we get into the conversion. So that's where we're starting to map to Modigliani Miller. All right, so I posted in Elms, in the files section, under homework 5, a solution. Okay, so the solution is there for all to see if everybody wants to kind of check your work, but I wanted to go over it in class today. So first part of your solution, hide this temporarily. Is you would have started out by doing the income statement or balance sheet first, right? The income statement, or so the balance sheet is probably the easiest one to convert. So I'll start here, okay? And the idea here is we have labeled everything off the statement balance sheet, 1, 2, 3, 4. We group our ones together, take all the asset ones, net all of the liability ones, and that gets us something called operating invested capital. Okay? We take all of our asset twos, net our liability twos, and that gets us non-operating capital. Operating invested capital plus non-operating capital, TFI. Okay, so this is the capital we've invested in, and the operating and non-operating activities of the business. Right? Now, one thing, I also went a step further in the solution, and I further took the operating capital and I put it into working capital and long-term capital. Now, that was not something that you needed to do. That was just something I chose to do. Okay? But the reason I chose to do it is I want you to start getting familiar with this format, because when we get to the valuation, this is the way that you're going to actually see the data presented, because we're going to actually forecast working capital to go up at a different rate than we do the longer term capital for the firm. Okay? But that was not necessary for this assignment. You could have just listed all of the asset ones, all the liability ones in a row, netted the two, got to this number, and that would be a correct answer. Okay. All right. Questions about any of this so far? Okay. All right. So again, now that we have broken out our operating and non-operating investments and add them up to our TFI, this is the idea of the balancing statement. This is then financed by all the interest-bearing debt and equity, all of the 3s and the 4s. So 3.7 billion worth of TFI, 3.7 billion worth of financing, okay? And so again, they have to add up, okay? So this is the idea and metaphor of Legos on the floor. We break the Lego down and we rearrange it. We still have to account for every single line item. So if there are 2 3s, we need to put both 3s in here. If there are 5 4s, all 5 of the 4s have to be in here. That's where the labeling can help you as you do these statements. All right, so key balancing. Other key to grading, okay? So here's another key to grading in this class. To get a correct answer, you must not only have the number, you must have a balancing statement. So for example, let's say that that was your solution. You had 37.25 of TFI, but you had 34.25 of financing TFI. One of those two numbers is correct, but they don't balance. Since I don't know which of those two numbers is correct with certainty, it's a 50-50 probability, then you get 0 credit for the assignment, okay? So to get credit on an assignment in this class, when I say balancing statement, not only must you have the correct number, but your statement must balance, because that's the only way that you know that it's a correct number. Because I don't know if 37.25 or 34.25 is the correct number when it doesn't balance. I can guess, but I'm making a guess. When both sides add up to the same number, I know I have the right answer. So one of the other benefits of this process, which I know you're not going to like, right? Because it's an extra work, is we balance statements in this class. And it means that you're less likely to make a mistake. In the real world, people don't balance statements. And I actually think it's kind of a flaw because you can make mistakes and not know, right? And in the real world, if you make a mistake, it can be career threatening. So this process, as much of it is a pain, will actually benefit you because you will get better at knowing how to do these statements without having errors. So another reason why we do balance statements. But this is what we mean by balance statement. This is the balanced balance sheet rearranged. Now we have a statement, clear. Here's my investment operations. Here's my non-operating investment, total investment. Here's how it's financed, debt and equity. Same process for the income statement. Okay. These are my operating cash flows. It's called NOPLAT. These are my non-operating cash flows, non-operating income. Add the NOPLAT, the operating income, plus non-operating income, total income available to investors, TII. So let me make it a little bit bigger. How about that? Does that help a little bit? Somebody asked if I could make it bigger. All right, so back to the TII. When you do the non-operating income, you'll notice that I am breaking this out so you can see what's happening. Pre-tax interest income, tax on interest income, after-tax interest income. Non-operating income, tax on non-operating income, after-tax non-operating income. Add the after-tax interest income and non-operating income, get non-operating income. So here's the point. You don't have to do this. Like you could have just skipped the process, not put the 20 and the 6 here, gone straight to the 14. You could have said equals, for after-tax interest income, you could have said equals interest income times 1 minus the tax rate. That would have been fine. Actually, you could have gone a step simpler. You could have added interest income and non-operating income together, taken it 44, multiplied that by 1 minus the tax rate, and gone directly to 30.8, right? If that's easy for you to do and you understand the way it works, I'm not going to begrudge that and I'm not going to hurt you in your grade, right? The reason why I write it out is that particularly when you're not familiar with these statements, it's easier to see where things are coming from, right? So by writing it out, it actually helps me as well when I'm first starting to work with certain statements, right? But nonetheless, if you're sophisticated, if you're fast and you want to take some shortcuts, as long as you get the answers the way you're going to be graded, did you get the right TII that balanced? Did you get the right NOPLAT? That's all we care about. If you take a couple shortcuts in here, as long as we can see your work, you will get credit, right? Now, back to this. The other side of TII. Here's how much income, that's the name of this, TII, total income available to investors, that I have to pay out to my investors. On the other side of the TII, which is known as the funds flow, these are my payouts. This is just an important concept, okay? This is not GAAP. And I'll say it again, this is not GAAP. If you think about GAAP statements, it will confuse you. It's Modigliani, Miller, McKinsey. So in these statements, income is what can be paid out. Therefore, since the statement has to balance, a 247.8 on the income side has to equal a 247.8 on the payout side, not negative 247.8. So it's not about absolute values, it's about absolute numbers. So in order for them to match exactly, then a payout on the structure of the statement is a positive number. I have income, therefore I can pay out that income in interest. If this were a negative number, if I lost money, then on the financing side, it'd be a negative inflow into the business. So payouts are positive numbers. Negative, losing money, are negative numbers. On the financing side, they would represent a negative inflow, okay? So since all of these are payouts, I'm paying interest expense, positive number. I'm paying minority dividends, positive number. I'm paying potentially net income to my shareholders, positive number. Payouts are positive numbers. The other trick to be aware of on the income statement, the TII, is the income statement stops with net income. So if you try and put dividends onto the income statement, it won't balance, right? So even though I gave you dividends, that was really just convenience for cash flow. The income statement stops here. And so the TII is the rearranged income statement. So that would have been TII, right? So questions about TII or TFI? Stop my share for a second. All right, could just somebody make some kind of noise and make sure that I can actually hear you? Just helps mute for a second.
Hello?
Okay. So I hadn't heard anybody. I want to make sure nobody's asking me questions. And I'm in some kind of echo chamber. All right, questions about any of this? All right, for the CFI, this is the solution, but I'm going to try and recreate the solution here in class very quickly because I know so many of you struggled with the CFI. You probably got the TII, TFI pretty straight. This statement is a little bit more confusing, and so I just want to make sure that I help you understand it. So before we recreate this, so CFI 330, I want to go back. Make this a little bit bigger so it's easier to see. To conceptually what we're about to do. Process document. We have the converted income statement. We have the converted balance sheet. Now we're trying to do cash flow. To get to cash flow, we take the cash from the income statement minus the change in the balance sheet. That's the definition of cash flow. Because if you think about it, a balance sheet are just two snapshot statements. That's all they are, two snapshots. And the income statement explains the change between the two balance sheets. That's really what an income statement does. You got balance sheet, income statement, balance sheet. So when we figure out cash flow, income statement helps us understand the change of the balance sheets. But then if there's any balance sheet items that are not flowing through the income statement, we have to account for them as well. So when we say change in the balance sheet, what we're saying is the balance sheet items that aren't flowing through the income statement, we have to account for, okay? That is what's going to help us get the free cash flow, the non-operating cash flow, the CFI, the debt cash flow, the equity cash flow. So we're going to go through that process, income minus change in balance sheet, 4 times, okay? So let's do the first time for the free cash flow. So again, if I were doing my CFI, we'll just take relative references to start. Copy and paste over the years. And by formula, the first formula would be to solve for gross cash flow, therefore no plat. Cash off the income statement, no plat, plus depreciation. That's just the formula for gross cash flow. No plat plus depreciation is gross cash flow. All right. So again, if I copy and paste those over, these are my ones. And again, conceptually, and this is just a theme for the rest of the statement, but depreciation is coming in here as a negative number, okay? Just arbitrarily, that's the way it was given to me. It was given to me as a negative number. So back to this statement. Its gross cash flow is no plat plus depreciation. So since it's a negative number, that doesn't make sense. I don't subtract depreciation because plus and negative would be subtracting it. So this is what I mean by we have to kind of use some common sense to flip the signs. Because the data was provided to me as a negative number, I have to say, to get the answer for gross cash flow, it's no plat plus depreciation. So either double negative or flip a sign to get to 457. And that's going to be true for the other 2 years. So those would be my 3 no plats. Okay. Now, gross cash flow minus gross investment equals free cash flow. The shortcut for gross investment I gave to you in the video, which is all you really needed to do, which is basically you take your change in invested capital, current year minus previous year, and then you add in current year depreciation. So that would have been your gross investment for year one and your gross investment for year two. And that would have led to my free cash flow, operating free cash flow, which is gross cash flow minus gross investment, 381 minus the 273, 654, and negative 475. Okay? So that would have been the quick and easy way to do this. Now, in the solution, I wanted to be a little bit more granular. So I also, in the solution, showed you the change in the gross investment in a more granular way. Okay? So how did I do that? Well, for gross investment, because I had broken out the balance sheet, working capital, then I could actually start out by doing a change in working capital. And in the first year, working capital went from 810 to 767. Okay, negative 43. Okay. Now, my next one would have been capital expenditures, also known as CapEx for short. Okay. Now, for CapEx, since I didn't give you a statement of cash flows, we would need to solve for CapEx. So how do we solve for CapEx? Well, I know on a balance sheet, if I take my beginning PP&E, and I add my CapEx, and I subtract my depreciation, I get my ending PP&E balance. Beginning PP&E, ending PPE. Okay, so if I just do a little bit of rearranging here, my CapEx, by definition, has to be my ending PP&E minus my beginning PP&E plus my depreciation. Okay, so that's just to solve for CapEx on any balance sheet. So that's what I'm going to do. So what I'm going to do is I'm going to say take my ending property, plant, equipment minus my beginning plus my current year depreciation, and that would be my capital expenditures. All right, I can double check that, because if I took on my TFI 2,400 plus 20, it's 2,420, minus depreciation, depreciation is 220, 2,420 minus 220 is 2,200. So that would get me back to that amount. So it has to be that as my CapEx. Right? Then I would look at any other operating items. So I had a change in goodwill. And my goodwill went from 250 to 300. So it went up by 50. So I spent 50 on acquisition premiums. And then finally, I had a change in other long-term liabilities, which went from 200 to 500. So basically, I need to flip that sign so that my gross investment, which would be the sum of this, would be negative 273, basically matching the one below. Okay, and if I did it right, 868. So here's the point. Gross cash flow minus gross investment equals free cash flow. Gross investment is an outflow. Because I'm subtracting the gross investment, positive numbers are outflows. I spend money on CapEx, okay? It's adding to my gross investment. That's going to reduce, as my gross investment, it's going to reduce my free cash flow. Spend 50 buying another company, acquisition premium. That's going to add to my gross investment. That's going to reduce my free cash flow. But working capital is different. My working capital went from, see it here, 810 to 767. I disinvested in working capital. I got rid of it. So because I disinvested in working capital, that freed up cash. That's the negative 43. Same thing with the other long-term liabilities. If I don't pay a bill and my liabilities go from 200 to 500, then basically I save 300 in cash by not paying bills. So that becomes a negative 300, right? So when I add it all up, I had negative investment, okay? Mainly because I didn't basically pay my bills and I didn't build inventory receivables. I reduced my working capital. And so the end result was I disinvested in investment. And that added to my free cash flow, 654. Versus the other year, had 393 gross cash flow, spent 660 on CapEx, spent 150 on acquisitions, spent 100 on liabilities. But I did also disinvest in working capital. But here I spent a lot more investment, negative free cash flow. These are all my ones. Questions about that? Hopefully fairly straightforward.
Professor?
Yes.
So in the solutions, did you break it down this way as well?
Yeah. This
Okay.
is the solution on the next slide. So I just want to let you know, like when you see this, now I did in a slightly different order, but basically why did I do this? I wanted to show you not only the shortcut, but the granularity. For this assignment, shortcut's fine. But beyond this assignment, when we start analyzing companies, the granularity will be more insightful. And we do valuation, the granularity will be necessary so that we can do better valuations. Okay. Other questions? All right, next part of the statement. We're going to now do our non-operating cash flows. These are any twos. So I'll start with my income statement. Do I have any twos off the income statement? Well, TII, I had two twos. I had my after-tax interest income, and I had my after-tax non-operating income. So these are things, again, that are adding to my cash flow that will eventually become cash that I can pay out to my investors. Make income, add to cash. Generate free cash flow, add to cash. Okay. Then I look at my change in balance sheet. Okay. There were 3 twos on my TFI that I got to worry about. Excess cash, equity investments, other long-term non-operating liabilities. So back to the statement of cash flow. Change in excess cash. Change in, what was the second one? Equity investments. And then change in other long-term non-operating liabilities. Okay. Tough acronym to say. All right, so my excess cash went from 265 to 370. So it went up by 105. My equity investment went from 595 to 250. Went up by 345. And then the final one, right, yeah, 105, 345. And then the final one, change in other long-term liabilities, equals, went from 50 to 30. All right. Now, I'm trying to get to a total non-operating cash flow, which if I add that together, the operating free cash flow, the non-operating cash flow, I'm going to try and get to a CFI, cash flow available to investors. Now, here's the point. What I'm about to do is I'm going to add these up to get my non-operating cash flow. Now, the signs matter because I'm about to sum them up. And I don't have a good rule of thumb for you. You have to apply common sense. And as you set up your numbers, you have to think about, all right, what's the direction of what's happening with the cash? So again, conceptually, on this side of the statement, anything that generates cash, income, etc., is going to add to the cash that I had to pay out to the investors. It's a positive number. Anything I spend money or lose money is going to take away from the cash I had to pay out to the investors. It's going to be a negative. So let's think sides. I make profit from my after-tax income, positive number. That makes sense. Leave it positive. I have non-operating income, positive number. Leave it positive. Don't change the sign. Change in excess cash. I take money in my checking account, I move it to savings, and I no longer have that cash in my checking account to pay my bills. That reduces my CFI. I have to flip that sign. Okay. So the metaphor, as I said, is if CFI is like your checking account and you're basically taking money and putting it into savings, you're reducing money that you can pay the debt of the firm. It's money that you can't give to me. You gave it to somebody else. So therefore, you can't give it to the debt holders. You can't give it to the shareholders. Okay. Same thing. Change in equity investments. If I spend $345 million basically buying stakes in other companies, I go from 250 to 595. Then on the CFI, that's going to reduce my cash by 345 million. Okay. Now, the third one is the change in other long-term non-operating liabilities. My non-operating liabilities went from 50 to 30, which basically means I paid off the liabilities. I had 15 liabilities, I had 30, I had to pay off 20. By paying off the liabilities, that also used cash. So in my solution, it's a negative 20 to my cash flow. Okay. So this is what I mean by you have to kind of look at the data it's presented to you. Think about, do I have the proper sign for the direction of the cash flow so that you can add them up to get the non-operating cash flow. 440.6 and 248. So that when I add my operating cash flow and my non-operating cash flow together, I get what's called my CFI, cash flow available to pay out to my investors. Again, pause. Questions. Make sense? All right. Next step, I have to do the second part of the statement. So I have this cash, and this is the cash that I'm paying out to the interest-bearing debt and equity holders of the firm. So I need to account for all those payments of what the cash was, if it's a positive number, or if it's negative, I had to find out where the 227 came from. I had to figure out the inflows that balance the negative cash flow that I have. So again, same process. Start with the income statement impacts. So for my income statement impacts, TII, look at my threes. The only three I have of the income statement is my after-tax interest expense. Now that is a positive number, and that makes sense because I'm actually paying the interest out just like it is in the TII, so therefore I don't have to worry about changing the sign. Balance sheet impacts. I have 2 threes in the balance sheet, short and long-term debt. So I have to account for those. Change in short-term debt, change in long-term debt. Now, you could have just put the 2 debts together and just done a total debt, and that'd have been just fine. Okay, but again, if I want to see the individual impacts, short-term debt went from 80 to 240. So 240 minus 80 is the change. And I want to think about that. So from 80 to 240, then I increased it by 160. Well, given what I just said, outflows, when I pay money is positive, inflows, I'm borrowing 160, are negative. Therefore, I have to flip the sign. Structure of the statement. Right? And I can copy that one down so that for long-term debt, I got my formula. These are my threes. So what this should tell me, the negative 400 here, is that I borrowed 400 of new debt. So my long-term debt should have gone up from 400,000 to 1,400. I went from 240 to 200. I paid off 40 of debt between this year and this year. That should be a positive payout, 40 payout in year 2. Okay, so those are my threes. Then I go to my fours. Now I go to my equity. And here is the first trick. The income statement stops with net income. So the reason why TII doesn't include dividends is because dividends are not part of the income statement, right? Now I had to give them to you. You usually get them off the statement of cash flow to do your cash flow, but the income statement ends here. That's why we stopped here with TII. But when we get to the cash flow statement, the net income is not the amount of money given to the shareholder. It's the dividends. So what changes when we get to the CFI is it's not net income anymore. It's dividends. And there are three types of dividends that are being paid on that income statement. The first, TII, you can see them if you count the threes, is the minority interest, or sorry, the fours. So we're paying out the minority interest as dividends to the minority shareholders. And since that's a payout, it's a positive number already. The other two are going to be the preferred dividends and the common dividends. Again, those are going to be positive numbers because they're payouts. I don't have to change that. So those are the dividend payments. Again, not net income, you use dividends. And then balance sheet changes. Off my TII, 1, 2, 3, 4, 5. I got 5 balance sheet changes I got to account for. First one, change in minority interest. Again, equals. Minority interest went from 300 to 300, so it didn't change. But just like debt, if it did change, let's do this here. Let's say it went from 300 to 400. Okay, if it went up by 100, that would be an inflow. That should be a negative number. So therefore, I would have needed to flip the sign. But it didn't actually go up by 100. Just get the sign right. We go back to this and put this back at 300. All right. Same thing with preferred stock. Preferred stock, change in preferred. Equals current year minus previous year. And again, I'm going to flip that sign just like I did for minority interest. And if I want to check that, copy, paste. So my fours, I should have a $100 decrease, or sorry, increase in preferred stock with a negative 100, which means it went from 200 to 300. Makes sense. Change in common stock, same thing. Change in common. So essentially same formula, equals current minus previous, flip the sign. Have my change in retained earnings and my change in treasury, which is the share repurchase. Okay. So again, retained earnings went from 1450 to 1512. That is an increase in equity. And treasury stock means when I buy back stock, it's a contra. So this is repurchase shares. When I went from 5 to 250, I actually increased my share buybacks by 245, which means I sent 245 to the shareholders. Therefore, when I bought back that cash, it's an outflow. I said 0 for a second. 245. So copy, paste. And when I sum all of these, now that I have the signs right, all the debt and equity should be 213.4 and negative 227. So that should be the balancing statement, which should tell me that I did it correctly. If I don't have a balancing statement, that means I made a mistake. Now, in this case, I intentionally made a mistake. What mistake did I intentionally make? Where did I screw up?
You included the change in retained earnings,
Yes.
so
Because
you would take those out.
if you did what I just did and you accounted for every item and you put in change in retained earnings, there is no amount of permutation you could have done to balance these statements. So for those of you that emailed me yesterday and you said, I give up, I'm having trouble, I'm at my wit's end for the CFI. I basically had a couple of different responses. Number one is you left Legos on the floor. Like you didn't count up all the 3s and 4s and you didn't put everything on the statement. So that was the first common mistake, okay? Second common mistake was you did net income when you should have done dividends. And the third common mistake was you change in a non-cash account does not impact cash flow. And retained earnings is a non-cash account. So that would be the problem. By putting in a change in retained earnings, we mix non-cash and cash on the statement, and the statement will never balance. So we take out the non-cash change, our statements balance. This is CFI. Questions?
Really quickly, I know you said this in the video, but I actually forgot what the reasoning was for not including retained earnings.
Which actually was just what I just said, which is because retained earnings is a non-cash account. On the balance sheet, we include it in the TFI because we're rearranging an actual balance sheet. And your balance sheet won't balance if you don't put it in there. But when you get to the cash flow, a change in the retained earnings is not cash. So therefore, by putting in that change in the non-cash account has zero impact on cash flow, and it will only mess up your cash flow calculation. So that's why we don't do it. Which is also the reason why we use dividends, not net income. Because dividends is the actual cash distribution to the shareholders, preferred and common, and minority. So that's the point. You use dividends on the cash flow statement, not net income. Because net income is a payment to the shareholders, but you haven't actually made the payment. The actual payment is the common dividend. So those are the two tricks you got to be aware of when you do CFI. And the other trick is what's positive and what's negative. Again, structure the statement. This is not GAAP. What the statement is set up, and this is the analysis we're going to start to do, is I generate cash flow, it adds to my CFI. I use cash, it takes away from my CFI. So the positive and negatives, does it generate cash, does it use cash? That's really what I have to start thinking about. And essentially the data feeds can mess you up because sometimes Bloomberg, I'll give you a specific example. Bloomberg is going to give you data from an income statement that costs are negative numbers. Okay? So you put in a cost of goods sold, you put in an SG&A, it's going to be a negative number. It's going to be a positive number. You can just subtract it. But Bloomberg's data feed gives you dividends as negative numbers. So what I'm telling you is you're going to have a cost of goods sold as a positive number, and you have a dividend as a negative number. They're both cash outflows. So you're going to have to make a choice about which one you flip the sign on, because you're either going to be subtracting positive numbers or you're going to be adding negative numbers, but you can't do the same thing to both of them. If one's a positive and one's a negative, and they're both going the same direction. So there's two parts of this. One is you have to be very careful about the data source that you get. And I'm just giving you this made up data source where all the negatives are already outflows. Therefore, I'm adding these negative numbers. But on the midterm, I could be tricky and I could give you operating costs as a positive number and then give you basically EBIT as revenue minus operating cost, as opposed to revenue plus a negative operating cost. And you should be able to pick that up right away because you should be able to look at that number and say, gee, operating cost is an outflow of cash. So even though Professor Perfetti put it as a positive number, he's obviously subtracting it. So I should be aware of that when I'm doing my analysis. That's the first part. And the second part is where does it go? Which part of the statement does it go into? And right now I'm giving you the labels and I'm not trying to trick you. I'm actually trying to teach you, but I'll give you an example of what I mean by this. So somebody give me a company. Any company will do as long as they're publicly traded.
Apple.
Okay, so let's go to Apple. And let's say that your group project or an individual assignment is on the valuation of Apple, and you're trying to understand Apple. And then you go to Apple's actual balance sheet as reported, by Apple, which Bloomberg in real time will be able to give you this data. And I'm going to give you a field in Apple called, I'm going to call this accrued expenses, which for a number of years was a pretty big number. Actually, they stopped doing it, so I'll ignore that. Why don't we put this into a different one? Non-current liabilities, other non-current liabilities, $50 billion. It's a big number. Operating or non-operating? What is it? Do you think other
non-operating?
Why?
Um,
Did you just flip a coin?
no, because they're non-current liabilities, so there wouldn't be there would be long-term liabilities that wouldn't necessarily be used for day-to-day operations.
But here's the point. Whether there's current or long-term doesn't matter whether it's operating or non-operating. So what matters is it operating, which means when I tie it to sales, if I sell more stuff, will I have more of these non-current liabilities? Or are they being generated by things other than sales? And that therefore it makes them non-operating. And I'm not saying that you might be directionally correct, but that's the point. We got to figure this out. Like in the real world, we're going to do some digging and we're going to figure out what the hell is this 50 billion? And is it more of a blend because it's some catch-all category? So we might actually have to go do some digging to figure out if this is operating or non-operating. But that's the point. Like here, I'm going to tell you whether it's operating or non-operating. In the real world, and this is a true statement for me as well, I don't know. Sometimes the categories are pretty straightforward. Long-term debt, that's a 3. It's always going to be a 3. Okay. Total non-current liabilities, well, maybe some of that's operating, maybe some of it's non-operating. Got to figure it out. Now we'll start developing some rules of thumb, but that's where you guys are going to have to go post-midterm when you deal with the real world. And we're going to be dealing with the real world pretty quick. But right now, we're just using some made-up companies to help us categorize and learn this process. Right? That was CFI. Final statement, TFI. Economic profit, EP. So also known as EVA, economic value add. Stern Stewart calls it EVA. Right? We can't call it EVA because they trademarked it, so everybody else calls it EP, economic profit. So here's the idea. 2 ways to calculate it. No plat, 161. Minus, then we do our BOY ROIC, which is no plat divided by last year's invested capital is the beginning of year ROIC, as opposed to end of year ROIC, which I didn't ask you to calculate, but would have been the current no plat divided by the current invested capital. Okay, it's 2 different ways to calculate ROIC. Now, what matters is more situational. So for example, if I'm doing a valuation of a chemical company and they build a plant that takes 12 to 16 months to build that plant, I'm not going to count the capital they spend this year towards the performance of the actual plant. So therefore, beginning of year ROIC. Versus another company which doesn't spend any money on capital except maintenance. So all of the capital in their PP&E is being used towards this year's sales. Therefore, end of year ROIC when I evaluate them. So we'll start to look at end of year, beginning of year differently based on the situation that we're in. But arbitrarily for this assignment, I just wanted you to do the beginning of your ROIC, just to do the calculation. So this divided by that is 4.9%. Okay, subtract your WACC, you get your spread. Spread, negative 1.1% times 3260 of capital that we started with. I destroyed $34.6 million of value. So it just turns the spread into a dollar value. Negative 1.1% of 3260, which is my beginning capital, gives me a $34.6 million value destruction, 1 period snapshot. 2 methods, everything balances. Method number 2, I made 161 of no plat, same no plat. Okay, capital charge. I started out with 3260 of invested capital. I borrowed it at 6%, which means I was charged 195.6 in interest. 161 minus 195.6, I'm 34.6 short of the 195.6. Economic profit, negative. Either way, both balance. And that's the idea. Every statement balances. Every statement, make sure we don't make a mistake. And therefore, it gives us insight once we have the statement balanced. So here's a company which is profitable, which in one of their periods is generating cash flow, both periods destroying value. That was the assignment. Again, questions about any of this?
For the capital charge, why does it say times? Is that supposed to be minus?
Well, it should be minus.
Okay,
Yes,
thank you.
that should be minus. Okay. Other questions? All right, here's the final thing. And I did this in the earlier class. It'll be in the solution that's posted. I did this on the TFI. This is kind of a preview of where we're going next. So now that we've converted these statements, I can create a clean operating ROIC. So in 2017, I now have off my TII an operating profit, no plan. 2017, before. I now have for 2017 an operating invested capital, 3260. That's my operating ROIC for 2017, 18, 19. No plat divided by operating invested capital. I have for 2017 a non-operating income, 30.8. I have for 2017 a non-operating capital, 465. Divide. Non-operating profit divided by non-operating capital, non-operating ROIC. I have what Bloomberg calls ROIC, which is my TII divided by my TFI. Because here's the deal. The reason why in homework 4 I had you calculate an operating ROIC is because in the real world and in every other class you will take, except for this one, when people do ROIC calculations, including Bloomberg, they mix operating and non-operating capital together. We're going to split it out. Okay? And that splitting out will give us a little bit better view of a firm than keeping it mixed. That's the advantage of this approach. It's a pain to do it, but when you do it, you get a little bit better idea what's going on, because when the average is really close between the two, because this ROIC is just a weighted average of the operating and the non-operating, it doesn't matter. But when it's further apart, it starts to matter. Okay? When it's further apart, think about your CVS assignments. In your CVS assignment for homework 4, which we started the class with, when I gave you a spread, the spread for CVS on an operating ROIC basis was not all that different than the mixed ROIC, which is the operating and non-operating blended. It's not all that different. So if you valued CVS based on this number, you're going to get a pretty close valuation in perpetuity that is if you use this number. But if you're valuing Anthem and their operating ROIC is 29% and their average ROIC is 12, you're going to get a completely different number when they have a lot more sales in the future and they don't invest in operating capital, because this number is going to start going up because they keep selling more stuff at 29%, less at the lower weighted average number, and they actually get a higher return over time. So that's the point. This is just an average. And I think it's a limitation to just use the average. That's why I am teaching you this process. Because what we're going to do is I'm not ignoring the non-operating assets. Okay? What we are going to do in this class is we're going to value this and we're going to value this separately in the future. This is the blend. And what I'm saying is the company doesn't always go up at a weighted average. These could go up at different rates. And that's the insight that you're going to get, which makes your valuations, I believe, a little bit better. And so that's where we're going with this process and with the analytics of a company. Right? And in case you're curious, my personal opinion about, well, why is this different than what I learn everywhere else? It's momentum. So again, as I alluded to in the video, I went to Wharton back in the late 80s. And my first textbook was Brealey and Myers. I think we were first or second edition. And I remember Ross and Westerfield, first edition. And those were the textbooks. They had just been written by the people that graduated Chicago in the mid-1970s. And so when we learned all the stuff, the formulas that were just fresh, wet ink. And by the way, this is when Bloomberg got started. And Bloomberg got started with Wall Street in the 80s with all the academics. And they all sat down and they said, let's standardize everything. And so they standardized on all the formulas in the mid to late 80s. And in that mid to late 80s, ROIC, the balance sheets were a simpler time. You didn't have companies like Apple with 200 billions of cash sitting in Ireland and giant tax avoidance issues. You didn't see the issues with net operating losses, where companies like the Trump organization could go a decade without paying any taxes. You didn't see issues where you had companies like ByteDance, which were being forced to sell 20% of their business to Oracle. Like, you didn't see these cross-country joint ventures. That world just didn't exist 30 years ago. I'm not saying there weren't non-operating assets, but nothing at the scale and magnitude that we've gotten complexity over today. Derivatives didn't exist. We barely had an option market. So when they looked at balance sheets, almost everything was operating except for cash. And so the original formulas were set up that way, to basically ignore the non-operating capital because everything was operating and to treat it as operating. Well, that's why this has diverged, because today we still use those formulas where we assume that the non-operating is trivial. And for some companies, CVS, it is trivial. For other companies, it's substantial. And that is where the formulas have been lacking. And that's the approach where this idea of Modigliani-Miller comes into play, because it gives you a little bit more insight to be able to split the two up, right? And sometimes it matters and sometimes it don't. But for our purposes, it will always matter, because that's the right answer in this class. And that's just additional insight you're going to have by taking this approach. That's where we're going next in the class with the evaluation. But in order to have a cleaner view of the companies, we got to put things into these buckets that the accountants don't. And they're not helping us with the statements that they create. So, sometimes we'll do some judgment, and not always going to be right. But that's the process that will hopefully try and make us better at understanding the companies that we're valuing and analyzing. So that's why we're doing this. And that's the next stage. Your midterm is going to be about converting the statements. So it'll look a lot like this. You'll do it during class time. The only difference on the midterm is you're going to have 90 minutes to do this, all the statements. So you get more practice for homework next week. For the group project, we're going to take the converted statements. We're going to start analyzing them. That'll be Wednesday's class. So on Wednesday, we're having another class. It will be a Zoom. It will be live. And we're going to go through how to analyze basically the income statement and balance sheet as a ROIC tree and as a CFI, and what kind of insights we can get. And that's going to be your next group project. Okay? So any questions before we end class today?
So for the midterm, is it going to be set up the exact same way this homework assignment was, homework 5?
Pretty much, just different numbers and probably different categories. The only difference is you'll be on a timer and you got 90 minutes. That's individual assignment. Other questions? All right. We will end our class today. And again, we'll see everybody at live Zoom on Wednesday. Have a good day.